Hello, Sit Room executives. Welcome back to another episode. In this episode, I sit down and chat with a 20-year veteran broker and senior managing director of investments at Marcus and Millichap that specializes in single-tenant net properties and shopping centers. We had a wonderful conversation that was not only limited to the retail aspect of real estate, but also brainstormed and thought about potential future implications on this sector as a result of automation and perhaps even as a lesson learned from the current virus pandemic. Oftentimes, I have thought about where I would be with multifamily investing when it comes time to retire and pursue other personal interests. I first heard about single-tenant triple net property investing several years ago, back after finishing my master's in finance degree. I met with a real estate PE company at the time that was only 10 months old, but had already acquired $600 million in triple net leased properties. Barry Wolfe is going to share his experience in this asset type and why many multifamily investors choose to roll over their profits into single-tenant net properties when they want to retire, maintenance-free, and collect mailbox money. All right, Sit Room executives, welcome back to another episode. Today we have Mr. Barry Wolfe. Welcome to the show.
No, thanks so much. Thanks so much for having me. Excited.
I'm excited to have you on here. You know, Barry and I, before we hit record, we were talking a little bit about what he's doing right now, and I'm very excited to share with you guys kind of another asset class that you can, or investment strategy that you could even consider. So, without further ado, Barry, if you don't mind telling our listeners a little bit about your background and what you're doing right now.
Yeah, absolutely. So I was an attorney for about 8 years before getting into the brokerage side. I've been with the national real estate brokerage company, Marcus and Millichap, since 2001. So going on about 19 years. And I specialize in selling single-tenant net lease retail properties nationwide. Those are the drugstore buildings you see in our neighborhoods, the fast food chains, the medical buildings, any of these freestanding, just largely retail buildings that we see all about our lives as we drive around our neighborhoods.
All right. And and you've been doing this for quite a long time. And so you've
Right.
always been focusing on triple net, right?
Correct. Yeah, basically since then.
Mm-hmm.
And retail properties, we sell some shopping centers as well. But yeah, it's a niche I've always been interested in the retail sector. Back when I was an attorney, I worked with developers, worked with a lot of Kmart developers. That kind of dates me a little bit, but Kmart developers, Walmart developers, folks that develop for a number of restaurant chains. So I actually worked in-house for a public company, retail company, Aaron's Inc. for a couple of years, ran their legal real estate department. So I've just always been in the retail sector. So when I got into the brokerage side, again, back in 2001, just gravitated to retail. It's what I knew and enjoyed, and just kind of could relate to it because, again, it's, all our lives we're eating at these restaurants, we're going to the drugstores, that sort of thing. So it's just something I always found interesting.
So, this show, typically we focus on multifamily, but this idea of triple net lease, and like I mentioned to you earlier, I came across this idea back in 2017. And I actually found it really interesting, and then later on I did a little bit more research and heard people call this mailbox money, right? So what
Right.
exactly makes triple net lease attractive to investors?
It's the passive nature of it. We actually come across via 1031 exchange largely, where we get a lot of folks coming out of multifamily and other more management intensive assets. I mean, with multifamily, it's far from a passive investment. I mean, you may not be doing it yourself, but somebody's changing light bulbs, fixing toilets, replacing kitchen appliances, upgrades. There's always something. I mean, it's a very management intensive. It's a phenomenal sector to be involved in, but it takes a lot of time, energy, and effort. And we see a lot of folks that come out of that. Maybe it's even first part of their portfolio, or maybe it becomes all their portfolio later in life as they just get fed up with that. Maybe they just want to move on to the next phase of life that might involve just slowing down or even retirement, depending on where, how old they are. And we get, a lot of those folks, again, gravitate to that mailbox money that, and a lot of times they're even able to increase or maintain their cash flow just with these passive investments. They sell a multifamily asset and they buy a portfolio of, QSR restaurants or drugstores or medical facilities that are all just totally triple net, which means as a landlord, you do nothing. The tenant maintains the building. They replace the roof if it ever needs to be done. They maintain the parking lot. They pay the taxes. They pay the insurance. The reason it's called mailbox money is all you do is you go to the mailbox and you collect a rent check once a month. Nowadays, actually, a lot of these tenants pay to direct deposit, but the term still applies. So they're just very passive income and just a great way to, run your life. And, these folks, all of a sudden, they start taking vacations. I used to say, you go on cruises. So hopefully we'll eventually be back to that. Just enjoying your life and, taking a very passive approach to still owning investment real estate.
So what is typically the play here? So when you're looking at triple net lease, like, I mean, I'm sure like with multifamily, you've got value add or opportunistic, and these are core plus. So what exactly is the play with triple net?
I think that varies investor to investor. We see there's definitely investors we work with that still are looking for that value add component. They might be looking for a deal that's got a shorter term lease, maybe a riskier tenant, a way that they can potentially add value by maybe replacing the tenant or extending the lease term over time. So we do get that where you actually these can be something more than passive, where you do have the opportunity to come in and add value. And then there's the other side of it is folks that are just looking for, again, the totally passive income. And those investors are probably looking for the long-term leases, the 15, 20, 25-year lease terms with a good quality, financially strong tenant that they just don't even have to worry about. They know the check's coming every month for the next 15, 20, 25 years.
So how would you go about, as an investor, evaluating these types of deals?
I think it makes a lot of sense to work with a broker. They're getting paid by the seller anyway. I like to think we're a very good option there. But I do think it's important to work with somebody, particularly if you've never invested in that sector. Just like when you first got into the multifamily, I mean, the folks you work with somebody to kind of help you learn the business, and you're working with brokers perhaps to help you find assets and opportunities. So I think it's important. I think it does make sense to talk with brokers. Certainly start, reading trade journals, reading about the sector, reading publications. I mean, I actually encourage folks to self-educate, reading books as well, listening to podcasts, going on LinkedIn, looking at, just knowledgeable people. But we do deal a lot with that, with folks that are coming to us, just help me learn about the sector. And we do that all the time, just explaining it to them. Here are the options. Here's what you may want to consider. And some folks, frankly, we'll sit there after talking to them and say, look, I'm not sure this is the right fit for you. Because it's not for everybody. And if they, sometimes it's yield expectations, they may be looking for higher return than you can get from a safe, secure investment. So it may not be it's definitely not the right fit for everybody. So we just like to have an open discussion, understand what expectations are, understand what their goals are, and give them honest assessment and feedback and thoughts if this might be something worth considering.
So when as an investor, when you're looking at the risk of triple net lease, because like you said, a lot of these are single tenant properties.
Right.
So how would they go about assessing the risk of that?
I think it's a lot. There's several different ways we look at it. I call it the legs of the table. There are different aspects you want to look at. It's the quality of the real estate, the quality of the tenant, the terms of the lease. What does that look like? How are the tenants performing? And to a degree, I think it depends on the age of the buyer, what's important to them. I mean, a buyer who's all obsessed with what really matters to them is security more above all else. I mean, maybe it's somebody who's 70 years old and they just need to know, I've got cash flow coming in for the next 15, 20, 25 years. I'm less concerned about the quality of the real estate. If the tenant ever leaves and it's not as good a location, I hate to say this, but I'll let my estate deal with that. That investor, we might look at something different than some other investors. Look, to me, location is very important. I think if I got a great piece of real estate, if my tenant ever doesn't make it, I can probably backfill that with another tenant. And this is a good time frame to discuss it. Obviously, we're going to see some vacancies upticks in the next 6, 9, 12 months with what we're going through right now. So quality real estate can be very important, but at the same time, there's some tenants that aren't paying their rent right now. So if you were living off of that, having that tenant paying rent could be ultra important. So maybe a medical tenant or drugstores that are actually doing very well through this. So that might be something for someone to look at. So there's a lot of different ways to look at it. And that's one of the things we do when we're working with an investor is understand what's really important to them, what's most important, and how do we help them achieve whatever those goals might be. And it varies from person to person.
Now, one of the things I remember when I first heard about the triple net lease model a while ago that I thought was quite interesting was on this topic of risk was when you have a tenant in your space, like part of the terms of the lease, and you can correct me if I'm wrong too, and part of the terms of the lease, you may even include some sort of like a guarantor clause from, let's say,
Right.
the overarching like national company in the case if you have a national tenant, right?
Yes.
So how exactly does all that work?
That's a big part of what we look at. And that's where some investors, I think, can make some mistakes. They could be buying Taco Bell as an example, and some investors make the mistake of thinking, well, I've got Yum Brands, I got this big, massive parent company on the lease, and that might be the case, but it also might be a situation where you have a franchisee, and even then, if they're, let's say, a 200-unit operator, some investors don't dig deep enough to, well, do I have the 200-unit operator as my tenant effectively, as a guarantor on the lease? Or a lot of these, maybe it's a 25-unit subsidiary where just their properties in Florida or some other location. So that's important to understand. I mean, what is the guarantor on the lease? What does the credit look like? And not just, what does the sign on the door say? So that's a big, big part of what we look at. And then digging into those financials and, what do they actually look like? How are the sales trending for that operator? And not, as far as the overall operator, but even in that particular location. So there's a lot of nuances and aspects of a deal that if you're not experienced and not knowledgeable about, you may not even know to ask the questions, and you can miss them, and it can be costly at some point.
I like how you just mentioned, you also mentioned kind of looking at the financials of the company that basically
Right.
is going to be operating out of the space, but also I think you also mentioned looking at the financials of the guarantor, or the national, if it is being guaranteed by the national franchise or whatnot.
Right.
So what would you say, to people out there that are oftentimes, a little bit turned off by looking at financial statements, like, oh my goodness, I just can't get this. How do you understand that? So what advice would you have to them?
That may be where you work with an expert, somebody who has done that, or you sit down with your accountant, even your attorney, consult with somebody who has reviewed those financial statements, understands them. And there's aspects of it, even like your rent to sales ratios, or looking at the EBITDA. And there's some components that, again, you may not even know to look at. So again, I think it's important to work with an expert, because again, the credit is, yes, you're buying the sticks and the bricks, the real estate, the location, the building. But financially, you're only as strong as the guarantor who is paying that rent. And if they're not trending positively, if their earnings are not strong, if they've got significant amounts of debt, which in timeframes like this become very, very important. Those are all aspects to look at, just trying to gauge the viability of that tenant long-term, and even looking at, beyond just the overall guarantor, but ideally, how are they performing at this particular location? Because that can be important also. I've even seen instances where it's a one-unit LLC, where effectively you've got, as the guarantor, is that one particular unit, and if somebody misses that and doesn't realize that, if that unit's not performing well, great. It's a large company, it's a 200-unit franchisee or even bigger. But if it's a one-unit LLC on the lease, it's very easy for that operator to shut down that location if it's a weak performer. And you, as the owner, you're just kind of left holding the bag. So there's just a lot of those aspects that, again, it's kind of the old adage, you don't know, you know what you know and know what you don't know. And if you're not asking the right questions or looking at the right things, it's easy to make a multi-million-dollar mistake in reality.
Yeah, I mean, you're taking me back to the time when I was a private equity analyst, and I remember looking at lots of financial statements of many different companies, and one of the things that you just reminded me of was this one company we were looking at acquiring, and the numbers just didn't make sense. the
Right.
the expenses for the size of his business, the expenses didn't make sense because the expenses, it was only about what I think it was 20% of revenue, and that's for a restaurant. Keep in mind, a high-end restaurant, a sushi restaurant, and it didn't add up, right? So I did a bit of a deep dive, and I kind of ended up honing in on the what were they, the staff expenses, employee expenses,
Mm.
his wages. And he had, I think it was about 400 employees or something along those lines. And what I later found out doing more research was that he actually underreported it. And I think he underreported it. It was by like 75%.
Well,
Yeah. So when you're looking at these things, right, and you're looking at these statements in your experience, what was kind of like one of those things that you probably wouldn't have even thought about that, but it just showed up in the statements, and that was kind of like your red flag there?
That's interesting. That's a really interesting question. I mean, one of the things we'll look at, and again, when you go into time periods like these, it becomes ultra important is, the amount of debt they have. What's the income, the debt? I mean, we'll look at, the personal guarantees, just trying to, how much cash do they have on hand is also, very critical. Again, when you get into periods like these, it's, cash is king. And, it's really easy in good times for, operators, and then for buyers or borrowers, you look at it and they're less focused on that. But there's, every 5 to 7 years we get, it's always, the reason is always different, but we always get a period like this. I mean, it wasn't that long ago we had, the Great Recession. I mean, we had a boom period for 7, 8, 10 years, give or take. But we've been bound to have, what we're going through now. And I've been discussing it with friends in the business where, what's going to be the cause of the recession in the next couple of years? So there's going to be one. And now we've been joking with each other. None of us anticipate it being a pandemic. But that's what's the cause of this recession. And that's the reason that, companies that were overloaded with debt and didn't have enough cash are probably not going to be surviving in reality. And that's a lot of those, restaurant operators that had too many employees or they took on too much debt, or maybe they were paying too much in rent. They could sustain themselves in the really good times, maybe just, marginally and month to month. But when something like this hits, then kind of the house of cards falls down, and we're going to see operators not make it. So those would be some things I look at. And really, again, paying attention, what's that amount of cash they have? If we're looking at individual operators, how much credit card debt do they have? Looking at personal financials, are they leveraged up? Are they kind of house rich and cash poor? Great, they've got they've got expensive vehicles. So they're showing $250,000 in assets there that, in reality, if they went to sell, are worth a fraction of that. They live in a really expensive house, but if what hits the fan, if they go to sell that, it's worth 50 cents on the dollar. So if their assets are all kind of in the houses, the cars, the things like that, but they have very little cash, then when we get in this sort of period, those are going to be the operators that don't make it. And those are the people I don't want to necessarily be investing in and own the real estate. So those would be some things that we look at very closely, even in the good times. And, sometimes the buyers, listen to us, and sometimes they don't, and they may still buy an investment that, maybe would have kind of advised them not to do.
Is there like a particular like for these types of period, is there like a particular kind of like that you're looking for, like cash flow to debt, or debt service coverage ratio type thing that you're looking at now that's kind of different than before, than like pre-pandemic?
Right. It's going to be interesting. I think right now it's almost, I hate to say, it's almost like everything's out the window to a degree. I think we're going to just have to see, again, getting back to maybe how much cash they've got. We've just never, I mean, even 08, 09, 010, 10, that cycle, or back in 9/11, or the dot-com bust. We've had periods we've been through where operators experienced decline in sales, where restaurants maybe even had to, year over year had a slight negative, increase, where sales actually declined, 1 or even maybe 2% year over year. We've never had a period where businesses were literally shut down for weeks, and maybe, I hate to say it, maybe months. So I think what we're going to be looking at is just how much cash. I mean, right now, as far as rent to sales, or income to debt, I mean, right now there's no income. So these companies have no. I mean, even restaurant operators that are doing drive-through, they're still off 30, 40, 50, 60%. So their income is still down dramatically. I think, to me, probably the biggest barometer is how much cash have they been able to accumulate to be able to sustain themselves? How deep have they cut their expenses down? Because nobody, income to expense ratio, there's no income. So that, to me, would be the biggest thing. I think this is going to be, I do believe the survivors going to be the ones that are sitting on and had been hoarding cash and therefore can make it through a period where they literally have no income. I mean, nobody's business plan had a model where they had no cash flow for a period of months. I mean, they prepared based on declines in revenue, declining sales maybe, but it never went to zero. So nobody prepared for this. So I think it's really the ones that have been, building a significant reserve account, probably the point where some people would have looked at and said, that's ridiculous. You've got too much cash on hand. But those are going to be the ones that sustain and come out of this really, really strong and pick up probably some great opportunities, whether it's buying, businesses that failed, large franchisees buying the smaller franchisees that couldn't sustain themselves, good operators picking up real estate locations that were not available to them as recently as 30, 60, 90 days ago. So I think it's going to be the ones that had been, hoarding cash would be, to me, the biggest barometer at this moment.
Mm-hmm. So the apples of the world are going to be the ones that make it through.
Yeah, and the extreme, and then just the other operators that also, I mean, we've seen like McDonald's. I mean, they're flush with cash. I mean, they also have access to equity lines and revolver accounts that are in the billions with a B. So the companies that also have just access to that cash, whether they had it on hand. But no, I mean, you're right. I mean, the extreme example: Apple, Amazon, Walmart, Target. Those companies that have been hoarding, in some instances, billions, or, in the extreme examples, even trillions of dollars in cash. You're right. I mean, Apple's going to come out of this just fine because they've been very, very flush with cash. But exactly.
Now, a lot of information and things that I've read in the past was just the retail sector back home. It just seemed as though it was kind of struggling, with a lot of even major retailers kind of closing up shop, reducing the amount of storefronts that they had around the country. How do you see all this going to play out, especially with now that we have the introduction of COVID? Because just in general, I would assume that vacancies were already kind of on the rise a little bit, right? For some of these retail spaces.
Yeah, a little bit. Vacancies actually had not become problematic. Occupancy levels in the retail sector had actually been quite strong. I mean, there's been all this talk about retail apocalypse and e-commerce, is going to kill all retail. And e-commerce is something that's important. And retailers, have been working on building omni-channel businesses so they could compete with Amazon. So that's something that's been evolving. But no, I mean, it's coming out of this, we're going to see an uptick in vacancies. I don't think there's any doubt about that because some of these retailers are not going to make it. It's interesting. I mean, we always hear, it takes 21 to 30 days to form a habit. And we've created, in this process, some habits where folks that maybe were not buying via Amazon or online before have been, with all of this, they had to buy via online, whether that's Amazon, Walmart, Target, Instacart, grocery shopping. So there can be habits coming out of this that have been created and will impact retail going forward. I'm still very bullish on retail. I do think as we get out of this, I think there's a lot of pent up demand. I think people were social, so I think want to go back to the restaurants. They want to go back to the experience of shopping and going to the stores, going even to the malls. So I do think we're going to see some fallout. We're going to see some retailers that don't make it. And I actually see that as a positive, whereas in prior cycles, it might take, Sears and JCPenney's, an example, have been hanging on by their fingernails for, really decades in reality. Some retailers like that, and boom, in 90 days, maybe wiped off the map. They're just not going to be able to survive. But I actually see that as a positive. Reason being, you're going to have, those that survive, there's going to be more market share available. Again, there's going to be some great real estate available that was not available before. So those operators that make it out of this, I think are going to be stronger than ever in reality. The process is going to be painful. There are going to be some companies that don't make it, which is always, you hate to see, but that's just the evolution. And that's evolution of the economy, that's just the way things go. The strong survive, the weak perish eventually. And I think we've just sped up the process. So I'm bullish in the long term. Short term, there'll be a little bit of pain. There's no doubt.
Mm-hmm. It's interesting that you mentioned how you think that there may be some habitual related type changes, and I was looking at a few articles and I saw what you mentioned Instacart, like the grocery shopping. And I saw
Right.
something about that today, actually. And some other things, and I remember when I read that, I was just like thinking, we haven't done that yet back home. That hasn't become mainstream because, I've spent 11 years in China, and it just seems, second nature for me to just pick up a phone, open up an app, and, order whatever it is I want, pretty much anything and everything that I want. I mean, especially like takeout with an app. You can access so many restaurants with just one app. And then, also even just groceries as well. And I could get the groceries within like an hour or an hour and a half, or get the food in like 20 minutes, And I just see that as just super convenient, And so I'm just quite surprised that hasn't really become mainstream yet back home in the States, and I'm also thinking, what could be the long-term implications of this? You're bullish on retail, right? But then what if, let's say if something like this, even thinking longer term, were to become the norm in the States, what would that look like for retail spaces? Will we see more warehousing spaces, kind of just pop up, kind of community warehouse spaces pop up? Or what do you think that will look like?
That's interesting, Gage. I hope this isn't something become an annual norm, or there are going to be challenges across the entire economy. It's interesting, like you said. I mean, I think China technologically, whether we want to admit it or not, is ahead of us. I mean, yes, we've had Instacart, and yes, we've had those apps you talk about, but it hasn't been widely. I mean, there are definitely people that are using those, but not. I wouldn't call it quite mainstream yet. But again, when we talk about changing of habits, I think that this might be the tipping point where we do see that. And it's interesting you bring up warehouses. I mean, one of the things I think we're going to see, and I've been talking about this, going back for about 6 to 12 months or so. Now, if you have these in China, talking about ghost kitchens or virtual kitchens that are effectively run out of, warehouses. You don't need that expensive storefront, but you get a collection of restaurateurs that run out of a shared kitchen that you don't go pick it up. It's not even available for go to walk. There's no dine in, there's no carry out. It's all done via delivery, probably largely via the app in reality. I think we're going to see that really grow. And I've been telling folks again for about a year or so, and I think this is only going to potentially accelerate that, where you do see that sort of thing. And you do see, other retail. So maybe warehouse space becomes even more important. So now I think that is very much so. And I think the retailers that survive and thrive going forward will be embracing, we call it omni-channel retail, which means they've got the brick and mortar. I mean, even Amazon has brick and mortar retail. I think that's an important component, but you are embracing the online aspect of that. And I think those that don't, embrace and really grow this omni-channel, which is the app, which is online ordering, those that aren't doing that aren't going to make it. If you're just strictly brick and mortar, it's going to be very challenging. But on the same side, I think it's very challenging to be strictly online. I mean, even Amazon, again, they've got Whole Foods, and I'm convinced they're going to be opening more and more brick and mortar locations that serve as almost mini distribution facilities of a sort. I mean, Walmart's a great example. I mean, they've been aggressively growing their online component, and now it's already been paying off, but right now even more so. So I mean, they've been ramping up to compete with Amazon for several years and investing billions of dollars to do that, and it's paying off for them now, and I think that's only going to grow.
I actually, a couple of things that you mentioned that came to mind. You mentioned the ghost kitchens and everything. That reminded me of a buddy of mine. He's actually from Texas, and he lives in China right now as well. And he started, it was out of the building that we lived in. I lived on the 22nd floor, and he was on the 6th floor, I believe it was. And this in 2010, he started a Texas barbecue delivery service out of his apartment. Yeah.
Oh, wow.
So talk about a ghost kitchen. And
Yeah.
and that was before, apps kind of became the norm and everything was done via phone, and it just took off. It really took off. It was really interesting. And he made a lot of money with that. And he ended up opening up, 2 physical locations. But yeah, what you mentioned, this whole ghost kitchen idea, I mean, that actually does sound quite interesting to have at home, because I mean, especially if you think for a lot of entrepreneurs and people that are undercapitalized, may not necessarily have the requisite capital, but they want to do something more. I mean, this could be a great way to even, spur more businesses kind of opening up, right? Because I mean, you could
I
have shared space or something, right?
absolutely. I'm very bullish of this. I think the challenge is the delivery component.
Mhm.
I've been saying, I think, the GrubHub and the Postmates, I think the food delivery business, I think, will really take off when we get to the point of whether it's autonomous vehicles or delivery by drone. And I'm
Mhm.
not sure if you've had some of that over in China. I hate to say this, but if you can, when it gets to the point where you can take the human out of the process of delivery from a cost standpoint, principally, and maybe even now from a germ standpoint to a degree, but it's very expensive to deliver for these restaurants to deliver using Uber Eats, using Grubhub, Postmates. A big chunk of their profit is going to those operators. So I think we've got to get to the point where you're taking the human out of the element, out of the process. So therefore, you don't have the tip element. You don't have a person delivering. You've got this autonomous vehicle, whether it's in the sky or on the street, doing it. I think ghost kitchens are going to explode. I mean, if you could have it, personally, I would love the idea of where you pull up one app and you got the family together, and one person orders the pizza they want, the other person orders the Chinese food, and the other person gets Italian. It's all coming from this one warehouse that's got a conglomeration of operators sharing supplies, sharing the kitchen. And I think you're gonna have some phenomenal people that are chefs that maybe don't want to run a restaurant, which is incredibly management intensive with all the staff and employees, but they love cooking. They love the idea of serving the community. That now you can go do that and just run, delivery restaurant with a few employees in the back kitchen, and that's it. There's no staff, no waitresses you got to deal with. The accounting is much easier. So I'm incredibly bullish of ghost kitchens and virtual kitchens. I think it's going to blow up, and I think it would be phenomenal for all of us, because I think it's just going to increase options, and it's going to be a game changer, I do believe.
Yeah. I've never really, you mentioned Grubhub, and what was the other one? Sherpa, I think it was, or
Postmates,
Post.
Uber
Okay.
Eats, delivery
Okay.
dudes. There's a
Okay.
few different ones. Honestly, we're even
Hmm.
seeing some national chains. I mean, Chick-fil-A has opened up a ghost kitchen as a test of sorts. I think you're going to see some of these restaurant operators with national brands. Maybe it's a Darden that has a ghost kitchen with each of their brands that you can order from. So the nationals, I assure you, are not going to go down without a fight. And I don't see the nationals going away by any stretch, or restaurants going away by any stretch, because that's a social component. So I don't want you to feel think I'm saying that, but
Hmm.
the nationals are going to open these as well, and they're going to get. I think the nationals are now realizing they need to ramp up their delivery and takeout portion of their business. That God forbid this happens again, they've got to be prepared. And again, they need to up their delivery and takeout portion of their business, and it can't all be in-house.
Now, one of the things, when you were talking, you mentioned the costs of the delivery, and it actually got me thinking about the delivery costs in China, because in China right now there are 2 main apps, like delivery
Mhm.
apps, and one is called Meituan, and actually Meituan was started by my business partner's college classmate.
Well,
And it's a massive company now. So Meituan, and then the other one is called Are You Hungry? That's like
mhm.
the English translation of it. And so these are like the 2 main apps now, and these are basically all delivery. That's all they do. So they have these cooperative agreements with many different restaurants and retailers and things, like all over the country. Now, one of the things that I realized was, like, let me just give you an example. So just the other day I ordered some Chinese barbecue, it was, In Chinese money, I spent, it was 70 RMB, which was about, how much would that be? Like $7, something like that, give or
Wow.
take. So 70 RMB, and the actual delivery cost to me was only 7 RMB, so about 10% of that. So which is like $1, basically. Um, so one of the reasons why the delivery cost is so low here, well, one, of course, the actual what is it, wage is much lower. I mean, that's pretty given. But I think the biggest thing why they were able to get it down was because they aren't just delivering to me. So even though they're going to different restaurants to pick up food for people, so as long as they're coming to this area, they're typically delivering to maybe like 4 or 5 people in this area. So they're kind of like dividing up the cost. We're splitting up the cost that way. Um, Maybe back home, that could also be something that could kind of help out rather than just delivering. Because I remember when I was in college and I worked for Pizza Hut as a delivery driver, yeah, every time I went out, like the rule was we could only deliver to one house. We deliver to one house and then we come back. That's really costly on gas and all these things, right? But what if rather than just delivering to only one family, you're picking up multiple orders and then you're delivering it to a few families, but in the same area to kind of lower
I could
those
see
costs.
I could see that in a New York, in a very dense urban area. I mean, I'm picturing where I live, particularly if you've got multiple apps. I mean, maybe, and that's where maybe it does work, because you've got 2 apps, and it sounds like maybe you live in a fairly dense, more of an urban, I don't know if it's like a New Yorkish type
Mhm.
environment with a lot of high rises or mid rises. I mean, I'm
Yeah.
picturing where I'm at in the suburbs, and your pickle suburbs where you've got lots of residential communities, and there are enough people ordering at the same time. And maybe when we get to the point where it becomes more the norm, and it's dinner time, so 30% of the population is doing that. So there's just a lot of this happening. Right now, we're just not to that point. So maybe someday it gets to that. To me, I think the tipping point and the trigger will be, again, I think it'll be more the autonomous vehicles, or maybe it's someday drones. I mean, I don't know if y'all are seeing drones flying around delivery yet in China, or if that's still
No,
out
not
in the
yet.
future. Okay.
Yeah, there are a lot of restrictions because a lot of the cities here are very highly dense. Like, just to give you
Yeah.
an idea, just on, if you could just picture, not even really like a full city block, but like a half a city block. And in my residence here, there are about 3,000 people that live in this community, in just my community alone. And the one that's just north of me, there are a couple of compounds, but that single community has, I think it's like, oh my goodness, 15, 20,000, something like that. This was a lot. It's like really highly dense. Yeah. So there are a lot of restrictions when it comes to like drones right now, that we see. Yeah.
And I
So,
don't see like drones in New York. I mean, I don't know when
uh-huh.
or if we'll ever get to
Yeah.
that point with the drones in
Hmm.
particular. I do think we'll get there with the autonomous vehicles. But
Yeah.
like in New York, I can't imagine
Hmm.
drones being viable flying, but flying between buildings and stuff like that. But yeah,
Yeah.
I think, and also you get security issues. That's
Yeah.
probably down the road, if ever again.
Yeah. Another thing you mentioned too was, you had mentioned Amazon, and
Mhm.
on the subject of the warehouses, one of the things that came to mind was, and I don't know if you're seeing this right now back home in the States, but in China, there's this app. It's called JD, and JD would kind of be like similar to Amazon. It's like China's version of Amazon per se. Now, the one thing that's kind of really neat about JD is, I would say, for a majority of the products they have available on their site, as long as it's through JD and not purchased through a third-party seller, you could typically expect to one of two things. You could either receive it the same day if you ordered it early enough, or you could receive it next day. And the reason why is because they have a large number of just these kind of like distribution centers. Like they have like a central hub warehouse, but then they have like smaller community distribution centers that they stock with some of these products. Do you think that that might even be, part of a trend for companies like Amazon to kind of follow maybe, or are they doing that right now?
I think the model there here in the U.S. is, frankly, I think Walmart has really executed on that well. And they've got well over 1,000 of these little mini distribution centers, and they're called Walmart stores. Mm-hmm. And that's where they've done a great job. Is you place the order, and it's something they have in the store. So they've got something Amazon can't do is these little these distribution centers effectively all over the country that again are the Walmart stores. That if you order it, either it'll be delivered same day potentially, or you can go pick it up in a matter of an hour. Just drive through, not drive through, but dedicated pickup lanes where they bring you the product out, and you could place the order in a matter of an hour to 2 hours. Go pick it up at your neighborhood Walmart. Home Depot is doing that as well. So I think that's where these retailers actually have the advantage over Amazon. Is they've got these little mini distribution centers all over the country already built that are their retail stores. Mm-hmm. I think the thought was that Amazon might do that, and I think they still may, kind of out of the Whole Foods locations where they obviously own Whole Foods. I could see Amazon also buying another national retail brand to use for that exact reason. I think it's to largely have the physical retail stores be like these mini distribution centers. I think that's perfect. I mean, that's where Walmart, Home Depot, Target, Lowe's, actually, that's their kryptonite against Amazon right now, I believe. And Walmart has executed on that probably better than anybody so far.
Yeah. So if we could if they could even further shorten the lead time, from the order to the time that they actually receive it, that would actually definitely give them an advantage.
Yeah. Absolutely. Which again, they're able within an hour or two, you place your order. I mean, Best Buy is doing that as an example. I mean, you place your order. If it's in stock, you could have it in 15, go pick it up in the next 15 minutes. Mm-hmm. Admittedly, you've got to go pick it up. But if there's one near you, but then, Walmart again is using these facilities and they're hiring drivers that, it could be within a matter of an hour to 2 hours, they're able to make a delivery. I think they will get to that point. And again, that's where Walmart is going to be able to do that, whereas Amazon may not be able to do. It may be able to do same day, and they're building distribution centers nationally. But I think that's where these physical retailers actually have an advantage and can really compete aggressively against Amazon rather.
So what do you see when you're faced with investors that are looking at triple net lease and this other sectors and whatnot? What do you see are some of the biggest either challenges or mistakes that they make when they're coming into this?
And that's a really interesting question. I'd get back to maybe just not focusing on the right things. I think some of them will they're just not focusing some of them enough on the quality of the real estate and the attributes of the real estate. Whether that's, the old adage, location, 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 where they're maybe buying, instead of something on a hard corner that's got long-term viability, or buying a property that's got hindered access or visibility. Certainly, maybe buying something the credit's not as strong as they think or realize. I probably get to those sort of things, or even buying, retailers that, maybe their better days are behind them. Certain sectors. I mean, we've had Mattress Firm has been through some challenges, and people were buying Mattress Firm, or again, looking at what's the long-term viability. I think even, right now, buying a bank, a single tenant bank building, a high rental rate, even if it's a great location, but if the rent's too high, banks are a sector that I don't think are going to see a lot of bank buildings, 10 years from now. Banks are closing a lot more locations than they're opening. So certainly looking at, what's Amazon proof, what's technology proof to a degree, and what are the sectors that are growing versus really in reality contracting.
Mm-hmm. So what would be a key piece of advice that you would have for new people out there that are considering this avenue?
I just take your time. Don't jump into something just immediately. I think like we talked about earlier, talk with experts, go learn the business yourself too, but talk with people that have been doing it for many years, that have worked on hundreds and hundreds of transactions, and seen the mistakes that are made out there, and can kind of shorten the curve for you and just help you understand the things that you might want to be considering and looking at a little bit more closely.
Okay. And how could people get in touch with you if they wanted to reach out?
By either email. I'm happy to share that with you if you like. It's just my first name dot last name barry.wolfe@marcusmillichap.com. Also, if they're on LinkedIn, I'm really active on there. I love conversing and trading messages with people on there. So that'd be another way as well. Just look me up, Barry Wolfe, with I'm with Marcus and Millichap on LinkedIn as well, and certainly very open to scheduling phone calls or depending where they're located in person meetings, but certainly phone calls, Zoom calls we're doing more and more of. So any of these sort of things also.
All right. Well, thank you so much, Barry. I mean, it was definitely a pleasure speaking with you. Really enjoyed our conversation.
No, likewise. I love hearing the international perspective of it. It's really intriguing.